Hi everyone, it's Jack Ball in the video, and today I'm going to be talking about Intel. Stock I cover a lot. I've recently, less than half an hour ago, released its earnings report and I've ran through it, so what I think of it. And the stock's actually up about 5%, 6% right now. Not really sure why. This is not an impressive quarter by any means. The stock's had an absolutely brutal year. Its last quarter was putrid in my opinion. 50% year to date. Over the last 5 years, it's been an awful stock to hold. A general slow decline in the stock. It's right near its 52-week low, if not bouncing above it slightly. It's currently playing over a 5% dividend yield, and it's trading at P ratios that we've not seen for Intel in a long, long time. But there's a lot more to dig into with this business. I think it's a supremely challenged business. We're going to go through the report now. Like and subscribe if you're enjoying the content. Let's get into it. So before we get into the real nitty-gritty, let's have a look at the headlines. And these are the three clear metrics that I like to follow. Revenue, gross margin, earnings per share. For the most part, they're about where Intel was expecting, if not above. Revenue down 15% year over year to $15.3 billion. This within its July outlook range. In July, when it basically announced that everything was out the window, it was going to be recording 20% less revenue than it was expecting. This is kind of within its range. Gross margin of 45.9%, down 12.4 percentage points year over year. 0.6 percentage points below the July outlook, which is not very impressive because at the scale Intel is, that's actually a massive amount. Earnings per share of 59 cents, down 59% year over year. This is actually 24 cents above the July outlook, so that's a significant beat. I'm not going to give it too much credit because these results in general show a severe decline in the business. Of course, they're going to blame macroeconomic headwinds, blah, 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 but this is above and beyond any other company in the sector is recording this sort of failure, in my opinion. The earnings per share is significantly above expectation. Revenue about in line, gross margin a little below. I'm not really going to give it any credit. A putrid last quarter and massive reduction in the guidance does not save you from what is generally a bad quarter. The primary reason they've gained for their failings, or to put it bluntly, excuses, is a near-term cyclical slowdown in the industry. Macroeconomic headwinds are causing industry-wide impact. They expect 2022 PC total addressable market to decline mid to high teens percentage, and customers are working through elevated inventory. Now, to me, this is just not good enough to be revenue to be down 15 to 20%. It's really not good enough. The likes of AMD and Nvidia are performing adequately in this time, as are many other stocks, without recording massive declines in their business. They should have at least been becoming neutral, 0%. They should have been losing growth rather than losing established revenue. On the plus side, they see long-term sustainable demand in the future. PC usage supports the TAM above pre-pandemic levels. Server total addressable market is holding up with pockets of weakness. NEX demand is solid, and a PSG backlog is looking robust. There are definitely flickers of light in this report, but overall it is weak in my opinion, and I'm not really sure why the market is up. If anything, all I can really believe is that expectations were on the floor. Next, I want to go through the results by the segments, the largest of which is the Client Computing Group, which recorded $8.1 billion of revenue. That is down 17% year over year, which is a tremendous decline. And in addition to that, operating income is down 54%, more than halved. Operating margin is also pretty much halved, going from 37% to 20% as they've lost some economies of scale. Lower operating income on lower revenue, increased Intel 7 mix, and investment in the product and process roadmap. Just not good enough in my opinion. Plenty of companies are able to invest and maintain good operating income. Lower revenue on PC demand softening, primarily in consumer and education, as well as OEM inventory reductions. Now, this is a plausible reason in my opinion across all. I've seen this in AMD's report. I've seen this in many reports. This is absolutely plausible, and I think is the sin that I can forgive the most is that there is lower PC demand across the industry, and this has caused a softening. But again, I'm not really happy that revenue is down 17% year over year. That is and particularly on the size of the revenues, they've lost $1.7 billion of revenue in a quarter. That is tremendous. The most concerned of the three main business segments for me is the data center and AI group. Revenue down 27%. That is an enormous decline for the second biggest operating unit. Operating income down completely. It's gone from $2.3 billion to zero. Obviously zero operating margin. That's for a 40% operating margin, which is a really healthy number. They saw lower revenue on lower server volume and customer inventory reductions. Now, looking at other reports, and I'm sure I will see when AMD released their third quarter report, I was just not really seeing this in the second quarter, whereas Intel was struggling with data center then. I was not really seeing that with other companies, and this is clear. This has been a segment that's had a lot of market share taken away from it by the likes of Intel and Nvidia over the long run, and it's only getting worse. This is a real worry for me with Intel going forward. Lower operating income on lower revenue. Again, these economies of scale for companies, this is kind of to be expected, but they're also investing quite heavily in their product and process roadmap that they mentioned before and increasing the 10 nanometer mix. This is basically sins of the father. They're having to invest heavily, very, very heavily, to catch up the likes of TSMC to get down to sub 5 nanometer scale, which Intel has really struggled with. There's such a large knowledge gap. They're going to have to spend billions and billions to bridge that gap, if it's even possible. And that is just something that Intel shareholders are going to have to get on board with. The operating income and therefore earnings per share is going to be reduced over the long term. A slight positive is that the Network and Edge group, which is the smallest of the three main segments, revenue was up 14%, but that very slight bright spot is immediately dampened by operating income of this segment down 85%, so operating margin going from 26% to just 3%. Higher revenue was led by strength in 5G, Edge and Ethernet products, offset by lower demand for Network Xeon. Lower operating income down on impact of softer demand on inventory valuation and investment in process and product roadmap. So again, this keeps coming up that their investments in process and product roadmap are ultimately hurting shareholders in the short term. They're going to have less earnings per share, less operating and less free cash flow to spend elsewhere, which is why I can see a very, very high chance that that dividend is going to get cut in the near future, because it's a 5.5% yield now. That is just really unaffordable for Intel with the sort of profits they're bringing in. Next up, the emerging business segments. I'm not going to focus too much on this because these really are kind of like Alphabet's other bets. This is something that they need to be strong in the future, but it's not the end all and be all. The total revenue across these three is less than $1 billion compared to the Client Computing Group, which brought in $8 billion. So it's not really that much to talk about. Accelerated Computing Systems and Graphics Group, revenue up 8%, but a huge operating loss. Mobileye, which actually went public with raising almost $1 billion when it went public. It's been up about 35-40% when it went public 2 days ago. So that is a bonus for Intel because they definitely need the money right now. Q3 revenue up 38% on higher demand for IQ products. Operating income up 12% year over year. You're not going to see that very often in this report. I think that's the first time we saw it. Operating income up. I'm sure that's going to disappear in the next quarter. Intel Foundry Services, which I believe is is going to be the future of this business, but once they get the money from the CHIP Act and things like that, was actually down 2% year over year. Operating loss extended, higher operating loss driven by increased spending to support strategic growth. None of these particularly impressive. The Mobileye growth is decent, up 30% year over year, actually recording some operating income, but the size of these is just not enough to really move the needle. And overall, from a performance segment, this is just a pretty poor report. Even if they're meeting their expectations, I don't agree that you should celebrate expectations being met when they are so poor in the beginning. And finally, the full year outlook. The full year outlook, they expect $63 to $64 billion of revenue. That's down 14 to 16% year over year, and down another $2 to $4 billion from the prior outlook. So it's actually getting worse. The previous outlook was terrible, and it's actually getting worse. Gross margin, they're expecting 47.5% gross margin. That's down 10.6 percentage points year over year, down 1.5 percentage points in the prior outlook. Again, getting worse. Earnings per share of $1.95, down 63% year over year, and down 35 cents from the prior outlook. So things are definitely getting worse, which leads again is why the stock is up. I can only guess the expectations for this were so poor. Net capex of $21 billion, which is absolutely enormous. That's like 20% of market cap at the minute, the way the stock's going. And adjusted free cash flow of negative $2 to $4 billion. That 100% means the dividend is going to come under pressure, in my opinion. I actually think that would be a good thing in the long term. Very poor for dividend investors in this company, and I apologise to anyone who's going through that because that will suck. But in reality, I believe the dividend is going to come under severe pressure in the near future. I think it'd be foolish to carry on paying a 5% dividend yield when they really need the cash flow elsewhere. Moving on to the stock, it's a really tough stock to value here. I mean, a 4P ratio of around 10 is objectively cheap for the industry, but not actually that cheap for Intel's historical valuations. It's been trading around here and cheaper for a considerable amount of time. Free cash flow is basically impossible to measure it on right now because it's negative. PEG ratio, it's expected to put in a lot of growth in the near future, but can you really rely on that at the minute? I mean, these are analyst expectations, of course, but they're not the end all and be all. Can you really rely on that looking at what's happened with the company recently? It typically trades or for a long time, it's traded under the S&P 500 despite having really strong gross margins, strong operating margins, and strong net margins. And that is because the revenue has been single-digit increases every year, and it doesn't really look like changing. They have a lot of headwinds that they really should be capitalising on, with the likes of the chip act. They're looking like they're going to get a lot of money. Kind of the end of globalisation in the chip industry in particular can only help Intel because it is going to be the main supplier for the US in terms of high-end chips, or that's what they're planning for, and it just doesn't look like they're capable of that right now. Overall, there's no other way of putting this. This was a terrible quarter. I think this is a supremely challenged business that is outright struggling right now. I am an Intel shareholder. I've been for a while, and I am currently down around 20%. I'm completely okay with that because this is a very long-term bet that I'm betting on the end of globalization and that Intel will be one of the leading chip manufacturers for North America in the not so distant future. But they have a huge gap to bridge to TSMC. I've heard reports coming out recently that they're going to announce layoffs despite getting a lot of money to the CHIPS Act to build these fabs in Arizona. I think for the near term, this stock is going to come under immense pressure. It's performing really badly. It has a 5.5% dividend yield and negative free cash flow, so I would imagine that's going to get cut pretty soon. Its earnings are quickly disappearing, so those PE multiples are going to start rocketing up, and I can see this stock going through a really challenging time over the next few months. Of course, coming out the other side, I think this company could be a real winner in the long term because the factors I mentioned, huge macroeconomic tailwinds towards the manufacturing of chips in North America. I think they're clearly well positioned to do this. I just think that this is an absolute hold, if not sell, right now. I'm really worried about Intel as a position, and it's the one that keeps me up at night the most. I think this is a future quarter, and I'm really struggling to see the coming out the other end for Intel right now. Of course, that's just my opinion. You should let me know what you think in the comments below. Let me know you think if this is a stinker or if you think it's a value play. Whatever you think, let me know in the comments below. Like and subscribe if you're enjoying the video. I'll see you again next time.